Education accounts take the long-term principles of retirement saving and apply them to a different goal, building a future for the next generation. They share the same core idea: use time and tax advantages to grow money efficiently, but the structure changes because the purpose is different. Instead of lifetime income, these accounts are designed for tuition, books, and education expenses. The most widely used is the 529 plan, named after the section of the tax code that created it. A 529 is a state-sponsored savings program that allows after-tax contributions to grow tax-deferred, with withdrawals that are tax-free when used for qualified education expenses. Every state sponsors at least one version, and while they share the same federal tax treatment, investment choices and contribution limits vary. Some are direct sold, where the investor buys directly from the plan, while others are advisor sold, offered through broker-dealers. The owner of a 529 plan retains control. They can change the beneficiary to another family member, move the account between state programs, or withdraw the money for non-qualified purposes if necessary, though non-qualified withdrawals face income tax on earnings and a 10% penalty. Qualified expenses include tuition, fees, books, supplies, and room and board for students enrolled at least half-time. They also include up to $10,000 per year for K through 12 tuition and up to $10,000 in total lifetime payments towards student loans. Because contributions are made with after-tax dollars, there's no federal deduction, but many states offer deductions or credits for residents who use their own state's plan. The contribution limit isn't annual in the traditional sense. Instead, it's based on the amount needed to fund future education expenses, often exceeding $300,000 per beneficiary, depending on the state. Contributions are treated as gifts for tax purposes. The federal gift tax exclusion allows $19,000 per donor per year. However, 529 plans allow a special 5-year election. An investor can contribute up to 5 times that amount at once, $95,000, and treat it as if it were spread over 5 years for gift tax purposes. That makes the 529 plan a powerful estate planning tool as well as an education account, because it allows large transfers of wealth that remain under the donor's control. Another education vehicle is the Coverdell Education Savings Account. It functions much like a Roth IRA for education: after-tax contributions, tax-deferred growth, and tax-free withdrawals for qualified expenses. Coverdell accounts have lower contribution limits, $2,000 per child per year, and income restrictions that phase out eligibility for higher earners. They can also be used for elementary and secondary expenses, giving families flexibility before college. Funds in a Coverdell must be used by the time the beneficiary turns 30, or they must be rolled into another Coverdell for a younger family member. Compared to a 529 plan, the Coverdell offers more control over investment choices, but less capacity for large-scale saving. The 529 offers higher limits and broader access, but with investment choices tied to plan menus. A third option, less common but still tested, is the custodial account. Under the Uniform Gifts to Minors Act, UGMA, or the Uniform Transfers to Minors Act, UTMA, an adult establishes an account for the benefit of a minor. The custodian manages the assets until the child reaches the age of majority, usually 18 or 21, depending on the state. Custodial accounts aren't tax advantaged, but they do allow minors to own securities legally. Any income or gains are taxable under the minor's Social Security number, subject to the kiddie tax rules, where unearned income above a certain threshold is taxed at the parent's rate. These accounts are irrevocable. Once the minor reaches legal age, they take full control of the assets, and the custodian can no longer restrict their use. That means money set aside for college could just as easily be used for something else. Suitability matters. A 529 plan is most appropriate for parents or grandparents with long time horizons and high contribution potential. It's ideal for investors who want to retain control, minimize taxes, and pass wealth efficiently. Coverdell accounts fit families with modest means or those seeking greater investment flexibility. Custodial accounts work for gifts that don't require tax deferral but need legal structure, or when the donor wants the child to have access at adulthood. For the exam, it's helpful to compare features directly. A 529 has no income limits, high contribution capacity, and tax-free qualified withdrawals. A Coverdell has income limits, small contributions, and broader expense coverage. A custodial account has no tax shelter, but simple access and legal ownership for minors. Education planning is an area where the details feel technical, but the intent is personal. These accounts exist to help families shape opportunity, not in the next fiscal quarter, but in the next generation. The Series 7 expects you to know the mechanics. Who owns the account? Who pays the taxes? And what happens if funds are used for something other than school? But the underlying idea is simple. When the future matters, structure matters. The way you hold and grow the money changes what it becomes.